On December 8, 2005, a simple typing mistake at Japan's Mizuho Securities triggered a financial disaster that remains one of the most infamous stock trading errors in history. The mistake involved the initial public offering of JCOM Company Limited, a newly listed recruitment firm on the Tokyo Stock Exchange. Mizuho Securities, a subsidiary of Mizuho Financial Group, was responsible for handling stock transactions for JCOM. That morning, a trader at Mizuho was tasked with selling a small portion of JCOM shares at a set price. The order should have been to sell one share at 610,000 yen, which was approximately $5,000 at the time. However, due to a simple human error, the trader instead entered the order to sell 610,000 shares at just 1 yen each. This was an immediate disaster, because JCOM only had 14,500 shares in existence, meaning that the sell order was over 40 times the actual number of shares available, and at an absurdly low price. The Tokyo Stock Exchange's system processed the order instantly. Traders and investors who saw the error reacted immediately, rushing to buy up the heavily undervalued shares before Mizuho could correct the mistake. High-frequency trading algorithms and automated systems executed transactions within seconds, causing a flood of buy orders. The shares were snapped up at lightning speed as traders recognized the massive opportunity to buy shares essentially for free. Within minutes, the order book was overwhelmed with transactions, and the situation spiraled out of control. As soon as Mizuho Securities realized the mistake, they desperately tried to cancel the order, but they were met with a major problem. The Tokyo Stock Exchange did not have a system in place to retract a trade once it had been executed. Despite Mizuho's urgent requests, the exchange refused to cancel the transactions, stating that once an order was executed, it was final. This left Mizuho in an impossible situation. Since the erroneous sell order had already been processed, Mizuho was now obligated to deliver 610,000 shares to buyers. But there were only 14,500 shares in existence, meaning the firm had to scramble to buy back shares from the market at their real price to cover the transactions. As traders continued to buy and resell JCOM stock at higher and higher prices, the stock price skyrocketed. The total financial damage had reached a staggering 27 billion yen, which was $225 million at the time. The sheer scale of the loss shocked the financial world. What should have been a routine stock order had turned into one of the most expensive typos in history. The controversy surrounding the incident quickly escalated, with Mizuho Securities blaming the Tokyo Stock Exchange for not allowing them to cancel the trade. Mizuho argued that the exchange's system should have had safeguards in place to prevent such a catastrophic error. On the other hand, the Tokyo Stock Exchange placed full responsibility on Mizuho, insisting that the brokerage firm had failed to verify the order properly before executing it. The scandal sparked a major debate over Japan's trading infrastructure. Critics pointed out that it was unacceptable for a modern stock exchange to lack basic protections against human error. The lack of a cancellation mechanism exposed significant flaws in the exchange's trading system. The backlash against the Tokyo Stock Exchange was so severe that its president was eventually forced to resign. In the wake of the scandal, the exchange implemented new safeguards to prevent similar disasters from happening in the future. Trading systems were updated to include fail-safes for erroneous orders, and stricter verification processes were introduced to reduce the risk of human error causing such massive financial damage again. However, for Mizuho Securities, the damage had already been done. A loss of 27 billion yen was a massive financial and reputational blow, and the firm sought legal action against the Tokyo Stock Exchange. Mizuho filed a lawsuit arguing that the Tokyo Stock Exchange bore responsibility for the disaster because of flaws in its trading system, which should have rejected such an obviously incorrect order. The case went on for several years, but in 2009, the Tokyo District Court ruled in favor of Mizuho Securities, stating that the Tokyo Stock Exchange had failed to provide a proper trading system that could handle order errors of this magnitude. The court had found that the exchange's refusal to cancel the order had directly contributed to the financial losses suffered by Mizuho. As a result, the Tokyo Stock Exchange was ordered to pay 10.7 billion yen, the equivalent of $100 million at the time, in damages to Mizuho, a significant but far smaller amount than the total losses incurred. Despite winning the lawsuit, Mizuho was still left with a substantial financial hit, making this one of the most costly trading errors in history.